Welcome to our 2026 investment update and outlook. Now, I did say investment rather than market. I know you're going to get into a lot of markets, Marianne, but with us being large diversifiers and asset allocators, clients have exposure to the stock market, but also the bond market and alternative investments that we've gotten a little bit more heavily exposed to. But I'm joined once again by Marianne Bartels, the Chief Investment Officer at Sanctuary Wealth. So Marianne, good to see you. Thank you again for joining us today.
Thank you for having me. It's a pleasure.
Super. Thank you. So I just want to dive right in as we sit in the mid-year. What's one thing that clients might be misunderstanding about this market year to date?
So I think it's even hard for professionals. So I'm not going to, just blame individuals. What's happening is the rate of earnings growth has exploded to the upside. And particularly in technology names, those that are leveraged into the artificial intelligence. The earnings are up 28%. And that's a number no one had on their bingo card. It's staggering. If you recall last year, there was a lot of questions around the spending on artificial intelligence, the large amount, and will that turn into earnings? And it had a very negative tone to it. Well, these companies just produced significant earnings. Yeah. This spending is actually making companies money. I think the other thing that people probably I don't want to say misunderstand, maybe just are not aware of, we're in an inflationary cycle. And I think because of what we went through in the late 70s, early 80s, inflation has a negative tone to it. But we wrote in one of our monthly reports that there's really three phases to inflation. And the first phase we call inflation boost. Actually, inflation in the beginning is really good, right? You get more money, more wages, you can spend more. Companies can raise prices, they get more revenue, they get more earnings. We're in that phase right now. We're in the good cycle of inflation. Now, does it mean it will go bad? Not necessarily. Can it go bad? It can. But right now, we're actually in a very good cycle. Memory chips are in high demand and there's a shortage. So what did NVIDIA just go ahead and do? Just raised one of its top chips 65% in price. Well, that's going to help them. Maybe a little misunderstanding. It's just that we haven't seen a phase like this in a really long time.
Yeah. Well, if there's demand there, I guess you can increase prices, and 65% is certainly going to add to the bottom line in revenue. Well, I know when we had our discussion in the beginning of the year, you described 2026 as more of a reset year, not necessarily a bad year. What does reset mean to you, and what should investors expect now in the second half of 2026?
So we talked about it was the midterm election year, and what the midterm election year is known for is volatility. And we have had a lot of volatility. We've actually even had a lot of news, headline news. What's amazing though, is you had oil prices at one point over 100. You had the Strait of Hormuz closed. Yeah. There's not an analyst on Wall Street that would have said that markets would just maybe go down 7 or 10%. We would have all had the markets down 20 or 30%.
It was surprising, yeah.
Very surprising. Well, the U.S. can produce its own, we can ship, but everybody drew down on their reserves. So there was enough supply. And now we picked a very good day to talk, because now it appears that we have a resolution. And oil prices are down again. And I can honestly say the oil markets so far have had this right. It looked like oil was topping, and now it looks like oil prices can trade down into the low 70s. Now, it may take us a few weeks or months to get there, but that's going to be a boost too. That's going to even be a boost for earnings.
Yeah. It has just really felt to me, and the word I keep using with clients and discussions is resilient. It's just been a very resilient stock market where there's so many issues and things to be scared about and geopolitical conflict, but yet the market kind of shrugs that off and continues to trend higher.
Because of the earnings. There's a fundamental, it all goes back. There's a fundamental foundation that's very bullish of why the market is so resilient.
Yeah. Well, I want to get into what's leading. So markets have been led by large cap growth and technology, which has been the case for a number of years, and now specifically AI. It's a narrow group of companies that's been the leaders. You think we're early, mid-cycle, or what's the leadership in terms of this trend going to be in the second half of this year and into next year?
I still think tech stays the leader. The industry group, which is the leader, is semiconductors. This has been a story that we've had for a long time. I don't think the story changes. I really don't think people, it's hard to comprehend that we're actually living in a period of time where we're going to dramatically alter our economy. The last time we really fundamentally did this was in the 1700s with the invention of the steam engine. Now, I've also related the infrastructure build on AI to when we built out the railroads. That was a very capital intensive time. That was in the 1800s. None of us remember that. And electricity, right? Because electricity touched everybody. Railroads didn't necessarily touch everybody, but electricity touches. So it's a kind of a combination of the railroads and electricity. And we haven't done that in a very long time. So I think this is transformative on levels that we still don't even fully comprehend and understand. How we're going to shift and work. I know there's a lot of fear that we're going to lose jobs. What people don't realize is we normally create jobs out of this. You know, yes, you may lose some jobs, but you create a whole new pathway. And yes, you're going to need educational change and things of that nature. But I'm not concerned that AI has taken all our jobs away. At least I don't think they're. I don't think they. Sorry, I don't think they're going to replace me quite yet.
Okay, but that is the big topic. Is companies are making some changes because of AI. They might potentially reducing the workforce. But yeah, there's two sides of that argument that AI could actually create a significant amount of jobs. The way previous technologies have aided in terms of adding jobs to certain sectors. So what I have is here is to your point, technology has been the leader. So here's the Vanguard Informational Tech ETF, VGT, representing kind of that space, if you will, versus the S&P 500 on a year-to-date basis, performance 24 versus 9, when it continues to lead. So other than this, what are you seeing as the best opportunities that's outside of the obvious mega cap technology names, or how would you be complementing that in a diversified portfolio? Because there are certain swings that can be, difficult. Any 1 month, 3 month, when sectors are out of favor, it can be a bit painful there. So what are you finding for those opportunities outside the mega tech handful of names?
So there's a couple of areas. One is the material sector, which is actually very small in the S&P 500, but it houses precious metals and it houses copper and industrial metals. And they are doing very well. There's leadership in there. And that's because we do have some inflation, right? And the industrial metals are because we're building out this whole big data center, right? And we need more power generation. There's a lot of infrastructure built. So that also helps parts of the industrial sector. Having wars and conflicts have been helping aerospace and defense. And even if the conflict is resolving, which would be a good thing, we have a whole replacement cycle between the war with Ukraine and all the equipment we've recently used. That's a whole build out, and that can take 10 years to actually replace all of the equipment. This is not something that gets replaced overnight. And then I really like energy. Like energy is down because oil prices are down, but it's a whole new big industry for the United States. And many of these companies, in fact, all of the companies, have really worked on their balance sheets. They have great cash flow. The larger ones have great dividends, and that adds stability normally to tech. Today's kind of an unusual day, but energy stocks can add some ballast to a portfolio. So those are in financials. I really like the banks. I think banks, because our economy is doing very well. Our economy is growing anywhere between 2 to 3%. Interest rates now, if we can keep oil prices down, the inflation talk should tame down a little bit. We're getting a new Fed chair. We have a new Fed chair. This is his first week, his first meeting, which is known as the FOMC meeting. It's known that he would like to lower interest rates. He has
Sure.
a different way of looking at inflation. So that actually would be very good for the economy, and it's good for the consumer as well. So, I like the financials.
Yeah. And if this conflict abroad is potentially easing, you might, if oil stays lower, inflation comes down, there might be an ability to, decrease rates in due time rather than we were looking at possibly increasing interest rates with inflation.
Yeah, and that's
What do you make
bullish.
of investors that, what do you make of US relevant to international in terms of what's happened so far this year? And I'll chart that out. And then also maybe even speak a little bit to small cap companies that have had a pretty nice 2026 after some difficult years, leading up to 2026. So I have here US market, S&P 500, small cap, emerging markets, and developed in terms of performance since January 1. Can you talk to us a little bit about what you're seeing, and are there any surprises with international large cap and small cap?
So there's no surprises here for me.
Okay.
No, this is all good. So one of the things that we talked about in the year ahead, and one of the big stories that I was seeing, is that it was time to invest overseas for a sustainable period of time. I believe non-US equity markets are now in what we call a secular bull market, where they can have leadership over a 10-year cycle, maybe even 15 years. And the US went into a secular bull market in 2013, and we're up over 500% since 2013. Never before in my career have I ever said to invest in non-US markets on a secular long-term basis. This is dramatically, I think, something new that US investors, normally it's like, okay, we'll go in for maybe a little bit and then it doesn't work. So we come out, we go in. I actually see that over a 10-year cycle, I think the non-US markets are going to do particularly well. And that includes developed and emerging markets. And small cap, we started talking about that. We started to see signs of a bottom. They've been in a secular bear market, and I think we're in the early stages of stabilizing. And of course, they've had a great run. I'm not sure they're ready to take over leadership, even though the returns are stronger than larger cap right now.
Sure.
But I think the story is that you really need to have a fully diversified portfolio. Even though I like tech, the market is broadening out, and it's broadening out in overseas. It's broadening out in terms of cap size in small cap. So having a diversified asset allocation is extremely important. I think is finally going to add to the returns. It's not just going to be a U.S. story anymore.
Yeah, small cap's been interesting, and an asset class that underperformed large cap for a number of years. Then there was the question of, okay, we're seeing that private companies are staying private longer before IPOing and going public. SpaceX was the big news last week. So the question was, okay, are you getting the exposure, and are you getting good quality companies in a small cap investment now that's public, given that they've stayed private a lot longer? So, maybe that is changing, maybe it's not, but I know we allocated towards private equity and have been investing in private equity for clients for the last 5+ years and have benefited from those returns that have been better than public small cap. But it sounds like there might be some opportunity for some nice returns in the public small cap space moving forward.
Yeah, I mean, I'm still a believer in the private markets, and of course, you can get access to companies that are not public, which has been a problem in our markets for a period of time. The other thing with small cap, a lot of the small cap companies just didn't have earnings. Now we're starting to see that, what we call an earnings trough, and we're starting to see an improvement in earnings. Always remember, it always goes back to earnings. Earnings are really the main key driver of why stock prices go up and are able to stay up.
So that's a key theme and something to remember from this call and into the future. So I always got to ask you, what are the biggest risks that could disrupt the second half? You have geopolitical, you have interest rates, you have inflation, you have new Fed chair. To you, though, and that's what we want to hear is what do you think are the biggest risks? What do you wake up and look at first thing in the morning? So what are your thoughts there for the second half of the year?
So I think our biggest issue is still going to be inflation. Inflation, I think, is back. Now, we saw a really bad cycle right now where we saw prices, like CPI and PPI go up dramatically. But with energy now, I think that's going to start to come back down. But I think over time, we're going to continue to have an inflationary problem. Now, equities are an inflation hedge. Real assets do very well with inflation. But if we ever get to a point where the Fed has to start raising rates, that will eventually become problematic. We used to have a rule of thumb on Wall Street called 3 steps and a stumble, that the markets wouldn't respond to any interest rate hikes until the Fed raised at least 3 times. Because it takes a while. If you have good momentum in an economy, you just don't stop the brakes. Yeah. So when we started talking about higher rates, and I'm like, that's why I started talking about 3 steps and a stumble. But I don't think we're there yet. But it is on my radar because it does become important for asset allocators in terms of fixed income.
Yes.
It means going out and taking long duration risk is probably what you don't want to be doing. You want to be more in what we call the belly of the curve, the middle of the curve down. So that's where I'm a little bit more cautious. And the same thing is, with our deficit. I'm not concerned about the deficit, but if the bond market starts worrying, meaning the investors and bond vigilantes start worrying about it, they can drive interest rates higher. So those are the things that I really monitor the closest that can really be problematic for investors.
That's great. Thank you for that. So here's switching gears a little bit. For long-term investors, what would be the biggest mistake that they should avoid right now? Long-term investors, what would be their biggest mistake?
Hitting the sell button, right? Panicking when news comes out. And you have to realize there's always bad news. And by the way, you're supposed to buy on bad news, not sell on bad news. And even let's say you do sell and get that trade right. Now you got to get another trade right when you're going to buy. And normally the buying, it's not a good environment when you really should be buying. So to stay with your asset allocation, you can review your asset allocation when things become volatile, but don't hit that panic sell button.
Yeah. Yeah, we've built our own process over the years in terms of rebalancing portfolios, and depending upon what that downturn or how big that sell-off or the news that sends the markets down is, we'll look to be buyers. But in the same sense, as those markets rise, we need to make sure that we're also taking profits and avoiding portfolios from getting overly aggressive. But as we've said, resilience has been what I've been referring to this market this year. It's been a very resilient market. The only way to participate is to own stocks and own them with the intention of it being longer term. So great, Marianne. So, here we are. We alluded to it earlier. It seems like there's a peace deal with Iran. How does that impact not only oil prices, but what are your thoughts in terms of this deal? Is this real? And we're seeing obviously markets move because of it, but give us your hot take, because this is only hours into the news breaking that I'm fortunate to have you with us today. So just break that down for us.
Well, it's kind of interesting that we got a deal on Trump's birthday and right before he went to the G7. So he wanted a deal for the G7. He's been alluding to that the deal is close. We shouldn't be shocked that a deal was announced, but clearly he wanted a deal when he went to go to the G7 where he arrived this morning. No one knows the answer to this at all. I wouldn't be surprised if you had a couple of skirmishes here and there. But I think they're going to do their best to keep this going because we're getting closer to the midterm elections. This is not good for the Republicans. It's not good for the consumer. And it's not good for an economy for a consumer that doesn't have confidence. So I think we can, as long as the markets believe that this is a deal, we're okay. So what I look at is I look at where oil prices are trading out in the future, right? And out in the future, the market is saying oil prices are going to be down in the low 70s. And all I can say is that the oil market has been correct. I've just learned markets are smart.
Yeah. Now you've mentioned consumer. Sorry to interrupt. You mentioned consumer a couple of times. How is the consumer doing? What's your opinion and what are you seeing?
That's another word where you can use resilient. The consumer is very resilient. I like to look at the Bank of America data because it is the most current data that's out there. They have a very good demographic and selection. And what their recent data just came out and said is that on a year-to-year basis, consumption is up 5.4%. If you take out gasoline, it's up 3.9%. The consumer's still spending. And in the data, what was also very bullish, because they can see wages, right, in terms of paychecks. Yeah. Wages are going up. And that's a positive because that means the consumer has the money to spend. And we've all been talking about a K economy where the high end is spending more than the low end. Well, now everybody's spending. In fact, it's more like an E that's tilted. You know, low end, middle, and high. It's just high spending more, but everybody's going up on a tilted E. That's great for the economy since GDP is 70% of the consumption of the consumer. So, you know, it's resilient across the board.
Great. I appreciate that. Well, thank you again for your time. It sounds like continued bullish the second half of the year on equities, U.S. equities, but also international as well. Would you say look for small cap to continue to have a pretty good second half of the year as well?
Yeah, that's correct. And, you know, for interest rates to be stable to down.
Great. Well, Marianne, thank you again for your time. Appreciate the mid-year investment update and outlook. Thanks again for tuning in. Always good to see you. Look forward to seeing you at a couple conferences or two before the end of the year.
That's terrific. Thank you so much for having me.
You got it. Bye-bye.